if at all you were to come across this chart or the screen, what would you imagine or what would you do? So this is a chart of basically this is a performance chart of last 3 years, 5 years since inception probably of a mid cap fund. I'm not going to name the fund and neither am I going to tell you which fund is this, but just try and understand what I'm trying to tell you. So this is a fund in the last 3 years has given a 35% CAGR return. Last 5 years has given a 36.85% return as far as lump sum investment is concerned. And if somebody had put in their SIP money, like a monthly money, in the last 3 years, it has given a 30.71% return, and in the last 5 years, it has given a 31.78% return. Now you can see this, what I'm highlighting here, this part, the benchmark, it has beaten it by almost 4.5%. So here and similarly here in the SIP mode, it has beaten it by almost 5 to 6%. So simply a super fund to invest in. So what would one person do based on the last 3 years, 5 years performances? One would simply jump in and invest in this fund. Now just watch what happened. Without looking at the sector allocation, which I'll just come to it in a bit, without looking at the stock allocation, which again I will come to it in a bit, what happened with this fund is, now how is it connected with IT? How is it connected with mid cap index fund? What happened in the last 1 year with this fund? What happened with the index since inception, and what happened since inception means since the start of 2025 till date, and what happened with this fund since 1 year and since 1st Jan 2025. So we'll try and relate all these things together and put it in a package. Now, what I'm trying to put across is what happened to this fund exactly is that this is a mid cap fund. Somebody who's wanting to invest their hard earned money into a mutual fund scheme would typically go back and see the performance reports of a particular fund and then take a decision, which is not the right thing. And I'll tell you why. Because looking at this, you might feel that this is the best scheme for me. And if I invest, like I'll just show you the calculation as well. If you put in say 1 lakh rupees of SIP per month in this, had you put a 1 lakh rupee SIP in this fund for the last 5 years, growing at the rate of 31.78, it would have become 1.3 crores. Similarly, if you had put a 1 crore rupees in this fund in the last 5 years, it would have become at the rate of 36.85, it would have become almost 5 times. That's 5 times in 5 years. That's almost like a wow return. So that's the kind of return which this has given. But the problem is it going to repeat itself? The big answer is no, it's not going to repeat, which the mutual fund investors don't, you can say, believe, or they feel that past performances are simply going to be the futuristic returns as well. But what happens is, the biggest mistake is, now the BSC mid cap, now it's a mid cap fund, that's why I'm comparing it with a mid cap index. In the last 1 year odd, what has happened is the mid cap index has given a minus 3% return, whereas in the same last 1 year, this has given a return of 9.5%. So again, it has beaten the benchmark by 12 to 13%. So this also brings us to a very, very important discussion or conclusion. I won't say conclusion, but like a debate. It's a debate, index funds or a passive fund versus active fund. So definitely a active fund is much, much better than index fund, at least as far as this discussion is concerned. Next, if we look at a 1 year return, it is 5.5, whereas the index has given a minus 3. So that's an outperformance of 8-9%. Having said that, if you look at the year till date return of an index, it is almost 0%. So it's nullified. Year till date means 1st January till date as we record this video. Whereas the fund year till date return is minus 9%. So that's the underperformance active funds or a mid cap fund like this can give if you were to just go by the past records of 3 years, 5 years and get excited looking at the past performances without looking at the futuristic kind of return potential which the particular fund has, and simply jump into a fund looking at the past performances. This is how dangerous or critical it can be when it comes to entering late into a particular fund by just looking at the past performances. So that's the limited point I wanted to make. But again, now as an investor, if you had invested in this fund, should you exit or should you top up? That's the big question. So that brings us to that discussion of the underlying sectors. So now the underlying sector has been is IT, which is almost like a 22% exposure in IT within this mid cap fund. These are few of the stocks which this, in fact, all the stocks which it holds. So mainly it is mid cap. So obviously you'll see all the mid cap names here. Now, when I try to show you this IT fund, so what has happened is from almost year till date, it has almost tanked. The IT index has almost tanked down by 20 odd percent. It was like, this is a IT base by Nippon, but just trying to make a point. So from 50, it has gone down to 40. So it's almost tanked down by 20%. And within that 20% downfall of that mid cap, 22% was contributed by IT. So it means almost 4.5 or almost close to 5% is the contribution by the IT. So here, when you see this one, this 9%, almost 5% is because of the IT, you can say, sector going down, whereas the index just went down, or actually didn't even go down by 0 or 1%. So that's the underlying reason of the underperformance. Now, the big question is, should you stay invested in this fund or not? If you're looking at a multi-year, then yes, it makes sense. But if you were looking at a quick return, like a 6 months, 1 year, then probably you did a mistake. So that is where the choice of fund and the entry time also comes into picture. I'll give you a quick example of another classic, you can say, mistake what the retail investors are doing. So this is, again, I've hidden the names, or I've just named it ABC versus XYZ digital fund. Now, from a name point of view, it looks the same, whether it is given by any one AMC called digital fund or any other AMC called another digital fund, but both are digital funds. And at prima facie, what we would think that, okay, fine, whether I invest in this digital fund or that digital fund, it's one and the same thing. There will be a slight difference, which I'm okay with. Ultimately, the mutual fund manager will take care of it. While that thought, the latter thought is correct, but it does make a difference if you don't know the underlying. Now, obviously, it is digital, so at least you know it's into software, it's into IT, it's into something to do with digital technology, so on and so forth. But when you go deep dive into fact sheets, and you'll realize that the top 10 holdings of this XYZ digital fund, I'm not going to name it, are generally the top biggest names which you can think of in the IT software industry, which is Infosys, Tata Consultancy, Tech Mahindra, Wipro, HCL. So this itself will constitute approximately 60-65% of the fund value. Whereas if you talk about the ABC Digital Fund, which is basically managed by another AMC, in this you will not see a single large cap, you can say, exposure like what this XYZ Digital Fund had. So neither has Infosys, neither has Tata Consultancy, neither has Tech Mahindra, Wipro, HCL. So all the top holdings are Coforge, Zensar, Apple, PV, FinTech, Hexa, Persistent. So that's the diversity which ABC versus XYZ Digital Fund has. And can you imagine the difference in the underlying returns? So just giving you a sense of 6 months return, of this XYZ digital fund, 6 months return is minus 12%, and year till date almost same. It has almost been minus 12%, whereas here the 6 months return is close to 0%, and year till date return is minus 4%. So that's like a difference of almost close to 8 to 10% on average. And that's exactly what I'm trying to tell you to all the retail investors there, that in case you're just looking at the heading, you're just looking at the past performances, like somebody did here, or somebody just came here, looked at the XYZ digital fund and thought, I'm excited to invest in a digital fund, without actually seeing the underlying, without actually studying the futuristic trends, and you just simply jump into it, and then you said I made a mistake, or you are too lazy to actually understand what mistake even you did, and you say that I'm a long-term investor, and you'll stay invested in a particular fund which is going to actually underperform for quite many months or quarters, then that alpha creation will be missing. And that is what the difference in terms of choosing the right fund, seeing the asset allocation, going through the fact sheets, being regular with in terms of your quarterly, half yearly, yearly updates, what are the changes within the fact sheets, within the fund houses, and then doing the asset allocation in the right, you can say, direction, as per your risk profile, as per your market, as per the market conditions, and as per your goals. That is what makes the difference as far as mutual fund selections and mutual fund allocations are concerned. So in case if you think that you can do all these things rightly, then thumbs up to all of you. But in case if you think this is something which is like a missing piece in that entire cake, and you want to have the entire cake all by yourself, then it is time to actually contact on these given numbers and book a free consultation, strategic call we call it, where you and our team will be connecting with each other, kind of doing a holistic overview of your existing mutual funds or your gonna be mutual funds, and make you understand, sit with you on a one-to-one basis and understand the allocation matrix. So we follow something called as the 4321 allocation matrix. It's there on our YouTube channel by the name of Tag Investments. You can have a look there. Otherwise, you can request our team members, they'll share it with you. So how to actually do the position sizing, how to follow the 4-3-2-1 allocation matrix, which is designed not to fail. So the main agenda or the main crux is that returns is a byproduct of risk. If you are able to manage risk, you are able to get maximum or optimal returns automatically. What you can control is the risk, and that is what exactly the 4-3-2-1 allocation matrix helps you to do. So we invite you for a one-to-one strategic call. That's a non-obligatory one, probably a 15 to 30 minutes of discussion, which gets you ultra clear, if nothing else. Thank you so much. Till then, namaskar and Jai Hind.